The impact of Federal Reserve rate cuts on the economy and markets. We have recently received confirmation that the Federal Reserve will proceed with rate cuts, as indicated by recent comments made at Jackson Hole. What does this mean for the markets, the economy, and your financial well-being? Here at All Things Money, we focus on educating everyday people on unconventional financial strategies that are often overlooked by traditional financial advisors. Understanding the federal funds effective rate. Many industry insiders lack a deep understanding of economic mechanisms. Our research follows the true dynamics of the economy, including the implications of monetary policy changes like interest rate cuts. Historically, from the 1940s through 1980, the Federal Reserve primarily raised interest rates, with some short-term rate cuts. Conversely, from 1980 to 2020, the trend was largely downward. If history is any indication, we may be entering a period resembling the 1940 to 1980 era, characterized by higher long-term interest rates despite short-term cuts. When recessions are likely to occur. Currently, we seem to be experiencing a short-term phase of rate cuts. Historically, nearly every recession has coincided with or followed a period of Federal Reserve rate cuts, as seen in 1957, 1960, 1970, 1974, 1980, 1981, 1990, 2001, 2008, and 2020. This historical pattern suggests that the impending rate cuts could signal the onset of another recession. Employment numbers. A significant indicator of potential economic downturn is employment data. Recent job numbers have been lackluster, with a revision that removed over 800,000 jobs from prior reports. Most new jobs created recently are government or part-time positions, indicating economic weakness rather than strength. The yen carry trade. What impact will rate cuts have on the stock market? The unwinding of the yen carry trade will be influenced by the Federal Reserve's rate cuts and the Bank of Japan's tightening. This places the stock market in a precarious position. This dynamic contributed to the recent flash crash and could potentially trigger another. Price implications. Rate cuts will likely exacerbate inflation. Although the rate of inflation has decreased, prices continue to rise, making it difficult for many to keep up with the cost of living. Easier access to loans for personal, auto, and corporate purposes will inject more money into the economy, driving prices higher. Government borrowing. The federal government faces challenges in borrowing through long-term treasuries and relies on short-term debt. Lower interest rates will make short-term borrowing cheaper for the government, leading to increased money supply and higher prices. This scenario will likely result in higher interest rates for private debt as lenders seek to protect their purchasing power. Conclusion. The upcoming period of lower interest rates will be short-lived. While there may be opportunities to refinance loans at slightly reduced rates, this will add to inflationary pressures. Consequently, interest rates for individuals will rise, and a recession appears imminent. It is advisable to minimize leverage and focus on income growth, while maintaining a portion of your portfolio in inflation-protected assets. For more in-depth insights and guidance on navigating these economic changes, consider subscribing to our channel, All Things Money. We provide valuable information on critical economic trends and strategies to protect and grow your wealth in times of crisis. Click the ATM link in the lower right corner below to subscribe.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.